All right, so thanks for joining me. Today we're going to take a look at buying the dip on Carvana without getting smoked. I mean, the stock's coming into the $50 price tag, so it is getting into that, hey, maybe it's oversold area and you might want to take a shot at it. But again, everybody's risk tolerance is a little different, so this is just my opinion and a strategy that you could employ, but not necessarily a recommendation. Okay, let's get started here. And before I do want to let you know that if you want me to work with you, you could reach out on our website at tradersfly.com, and you could do a one-on-one coaching session where I can talk to you and work with you on your strategy, portfolio, or that kind of thing. Or I can deal with a little bit more in-depth things if you want to do mentoring, which is like 3 to 6 months time frame, working on strategies and skill sets to make sure you understand what you're doing and what's going on. So check those things out on our website, and you can learn a lot more and we can work together as well. Okay, let's go with Carvana. And you can see here's Carvana. It's down quite a lot. And just overall, if you look at the weekly and monthly time frame, oh my God, that chart looks nasty. So looking from these highs from about 370 down to about, it got into $30 right now. In that $30 range, we're down like 92%. Oh my goodness. And now that stock's at around 37. So how do I buy the dip on this stock without getting clobbered or smoked? You can see it's coming into some technicals, and you could say, hey, I'm going to play the technicals. Yeah, but price is still out a little weak. So buying the dip here could seem not a bad idea, but again, I want to do it carefully. So how would I approach something like this? Well, first off, we're going to do this with a diagonal. Okay, so let's get started with a diagonal. And we're going to go to CVNA. So we're going to get started. We'll type that in. And I do want to give myself time. Why do I want more time? It's because I don't know if that stock will keep pulling back for another week, another 2 weeks, another 3 weeks. So I want to make sure I give myself some extra time. And that extra time allows that stock to maybe bounce or go in that direction, because it takes time for a boat to turn around. So that's what we're doing. Like, this thing is sinking, it's going down. It takes time for it to kind of come back to the surface, or it's going one way. How do I turn it around? It takes time to rotate that position. So I'm going to go somewhere around this 36, 43 days, or 43 to 50 days. So that's going to be kind of where I'm playing. I think I'll go with 43 days just because I get a little extra time, giving myself the gift of time. And I'm going to go in and buy a calendar. You can say, oh, you said diagonal. Nah, yeah, I did, but we're going to start with a calendar first. Okay. So here's a calendar. Okay, and we'll get rid of all this other stuff. I just kind of want to see what things are being traded at and what's kind of the spreads and so on. Okay, so here's a calendar setup, which is at the same strike. And then what I'm going to do is, if this thing's bullish, well, let's see if we do a 45 right there bullish. You could see already the skew, the way it's skewed, it can give me some bullishness to it. So I'm going to go in right here, switch this calendar, go to custom. And then what I'll do is see if I could do a rotation here, but you can see it's not traded. So I go from 44.5, it's not there. 44, it's not there. It's probably going to have to go down to the 40s. There we go. So now I've got myself a diagonal. Okay, so there we go. So I've got myself a diagonal spread, which is basically a covered call alternative. And if I'm worried about getting smoked over there, what I can do is move this back and let's say, hey, can this be traded over here to the 35s? And this one maybe to the 40s. And now I've got a little bit of a better spread. How about a 30 and a 35? Okay, now we've got something cooking. All right, so I've got a little bit of a spread here. And let's just say we're doing like 5 contracts. I'm going to go with 5. Okay, I've got 5 contracts going. I've got this diagonal. My issue here is if this pulls back, I'm still going to be down quite a lot of money. If it goes down to $20 a share, I'm down to, let's say, $1,000. It's a $1,700 trade. It's not something to sneeze about, right? Money's money. So if we want to go ahead and hedge that off, what I could do is go in and get something like buying an extra put. Let's go around the 27. You say, why did you choose the 27? It just looked good. So I can smooth out right here. Really, I'm choosing the 27, just the delta's around 20 right there to kind of smooth that out. I got 5 contracts versus 1 here. I could do a 29 and that'll help smooth that out a little more. So if it keeps going down, I'm only losing about maybe, let's just call it $350. I don't want to lose the full 1,000, but if this stock really does tank down to 10, I don't have that much of a problem. So this is where having this extra put kind of helps. So I'm getting this extra put right there to kind of help offset that risk or loss. And again, if you want a little extra protection, just get it closer. So what's the trade-off here? Well, the trade-off is that now I reduce the amount that I would make. So the profit potential that I would make is less, but the risk is also a bit reduced. So if it does continue to crash and keep going down, it's not as bad or nasty. Like it'll still give me a cut, like it'll still cut off a little bit of, your finger or something like that. Just like playing with a sharp knife. But what it won't do is it won't take the full trade out. It'll just, it'll hurt, but it won't be too nasty. So the way that you would work this spread is you could say, hey, I'll go into Carvana, I'll pop that in, and then I'll buy that. Once you get filled on one, then you'll go ahead and you'll buy the next single. Now, I just went ahead and did it kind of together right off the bat. But you do want to make sure that the spread gets filled first, because if not, you could be trying to play and get into the spread and you may never get filled into the spread. So be careful, make sure you get filled in the spread first and then do the single, because otherwise you'll have to kind of keep paying up and keep paying up and keep paying up, and the market's kind of working against you. And then, at the end of it later, you kind of realize, okay, well, it's, it's not a trade that's working out as well. And then you have to get out of the other one. So I could try this with the put side real quick. That could also work. Not that it matters that much for our trade purposes, but I could go ahead and see if the put side will get kind of filled here and play with it that way. So anyways, I won't bore you with trying to get filled onto this one. It's just part of the playing process of it. But that's the trade construction, and that's kind of what you would look to do to kind of hedge and protect the position. So that way, as it goes against you, or maybe it keeps pulling back, you don't lose as nasty or heavy, or you're trying to catch a falling knife. This is one way to do it with some protection. It's kind of like, hey, you could play with fire, but wear some protective gloves, gear, that kind of stuff. You could play with knives, but it's nice to wear a glove, right? If in case you cut yourself. So that same kind of thing. Playing with chainsaws, yeah, wear some chainsaw pants. So here in this case, we're trying to catch a falling knife. Yeah, we'll get an extra put for protection just in case it keeps going down. So that's what we're looking to do. And that's a little bit of a trade idea and example for you on Carvana. All right, thanks again for joining me. Enjoy the rest of the week ahead. I'll see you next time, or maybe in a live class session or a one-on-one session. Thanks again. I'll see you then.